Trading in cycles means rolling the trade from expiration to expiration, keeping the trade going over time, over and over and over again for a long time. An investor couldn't possibly trade a long cycle and just keep rolling expiration after expiration if they're doing it actively and only trading covered calls, cash secured puts when implied volatility is overpriced. Sooner or later, it's not going to be, and they would have to stop. Quite a dilemma, isn't it? Should I forego requiring volatility edge for the sake of continuing the cycle? Or should I just sit this one out and wait for volatility to come back up higher before I sell more options?
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family. Welcome to episode 47. But before we jump in today, let's talk about how you can get the most out of the Wealth Building with Options community. First, make sure you're subscribed to the show in your favorite podcast app. You don't want to miss anything. And if you're already subscribed to the show, you can go even deeper and get more out of what we talk about with a paid subscription. With your paid subscription, you'll get video extra podcast episodes so you can get hands-on video training on things we talk about on the show. You'll get subscriber-only posts where I'll drill down on a stock, an event, or a trading opportunity and share trade ideas to help provide an understanding of what's really going on in the market. You'll get all my covered call and cash secured put trades that I'm making in my real brokerage account. You'll get access to our monthly online Ask Me Anything webinar, and you'll get our unusual options activity alerts on options income trades like credit spreads and so much more. But the best part is your paid subscription helps keep this show on the air. And let's welcome our newest paid subscribers. Welcome to Angel. Thanks for joining, Angel. Welcome to Victor and to Jen, and welcome to Amir. To join this list of wealth building paid subscribers, just go to wealthbuildingpodcast.com and choose a monthly or annual subscription. Or for the best value, become an all-in wealth builder and get everything I mentioned earlier, plus our Friday group coaching, our smart income video class, and get on the wait list to get a signed copy of my new book, Build Consistent Wealth with Options, which is scheduled for release on April 28th of 2026. Last week, we started talking about volatility analysis. We talked about the 1, 2, 3 volatility analysis, which shows how to tell if options are overpriced or underpriced. And that's really important. But the question is, well, just how important? Oh, gosh. I mean, I could do a whole podcast episode just on that, just on how important implied volatility analysis is, which actually we're already there. I'm starting out this episode on that right now. Haha. Sometimes implied volatility, sometimes it's not that important. Sometimes it's super important. A decent analogy is an NFL field goal kick attempt. Now, for those listeners outside the United States, the NFL that I'm talking about here, that's the National Football League. And by football, I mean American football. not what many Americans call soccer, which is what the rest of the world calls football. I know it's a little confusing. So for our non-US friends, just know that I'm talking about a very different sport than what you call football. It's a different shaped ball, different scoring objectives. It's just different. Anyway, for an NFL kicker who's about to attempt kicking a 3-point field goal, there are a lot of factors as to whether he makes the kick or not. The biggest factor is skill, right? Skill comes from practice, practicing hard, working out, and it probably comes from some natural talent too, to be fair. Another thing, hey, the ball has to be snapped properly from the center to the holder. The holder gets it right on time, really quick, tees it up perfectly, holds it steady. Also, the linemen have to hold off the defense to allow enough time for the kicker to get the kick off. All these things are important. How about the wind? Well, that could be important too. If it's so gusty it's hard to even aim the kick, okay, that's one thing. But, I mean, even if there's a little wind, like a breeze, it needs to be accounted for as well, on the highest level anyway. I mean, a professional NFL kicker is going to want to observe the wind and use that information to adjust technique. Using this information will enable the pro kicker to be more likely to score the field goal than some amateur who doesn't have the knowledge or experience to think about it. And I guess that's kind of the idea when it comes to volatility analysis. Is the level of implied volatility ever super important? Well, sure. But more often than not, it's this one extra consideration, this one extra thing that if I take into account, I'll do better overall than I would if I don't take it into account. It's this extra thing. But it's an extra thing that matters. On each trade, it usually helps a little. But in the long run, all those instances of just a little help add up. They make a huge, huge difference. Let me give just a super, super quick review of what we talked about last week. And I know if you're binging this, don't worry, I'm going to be quick. I like to call it the 1, 2, 3 volatility analysis, where the first thing is today's implied volatility in the top half or the bottom half of the 6-month range. If it's in the top half, that can indicate, that's one indication that it might be expensive. If it's in the bottom half, that's an indication it could be cheap. Because we're selling, we want to identify options that are expensive. The second one is the implied volatility of the option being considered. Is the implied volatility in the option chain above or below historical volatility? If it's above, that's another indication that volatility could be high and options are ripe for selling. If it's below, then you wouldn't want to sell. And then number 3, is there an expected catalyst that can cause volatility to move in the future? So we're going to cover a lot of these things. We're going to cover actually all this. We're just going to pick the ball up and run with it here. All right. Exactly how important is implied volatility for covered calls and cash secured puts? One of the things that matters is whether the investor is actively or passively trading the wheel. There is clearly an unarguable mathematical advantage to selling options when their implied volatility is overpriced to varying degrees. Again, it's not the most important factor. Not really. Investors who have the skate objective don't want to end up with their options in the money, resulting in assignment or resulting in negative scalping the option when they roll to avoid assignment. And trade objective investors prefer that the stock doesn't blow through the strike and result in assignment at a lousy price relative to where the stock moved to. As with most option trades, the underlying stock's price movement is the most important feature in wheel trades. Where's that break even? Where's that indifference point? Where's the kink on the P&L diagram? Those are typically the most important things. Second most important thing, I would say, is theta. Option decay erosion is where it's at when it comes to wheel trades. I mean, that's the whole point of doing wheel trades, covered calls and cash secured puts. Optimizing theta is really, really essential step in trade setup. Imagine if you sold a call against the stock that you own, and so thus you give up upside potential, but you didn't get any theta. You didn't get anything for it. Why would you do that? You wouldn't do that. Theta, decaying options, is the benefit that justifies giving up the upside. This is where volatility starts to come into play. It's the head start of a race. But if you didn't train for the race, if you just ate a big burrito or something like that, your shoes are untied, I mean, you're not going to win the race either, even with the head start. Overpriced implied volatility is where option sellers get what we call edge. It's important. If the risk premium, and we've talked about the risk premium on the show before, if the risk premium didn't exist in options, covered calls and cash secured puts, they would not work at all. What's the risk premium again? It's if you look back and use a pricing model and you looked at the volatility of what a underlying stock or ETF was over a certain period of time, then you can tell in hindsight what the implied volatility should have been. But what we generally see is that the implied volatility, when it's all said and done, typically ends up trading at a slightly higher price point than it should have. Options are slightly overpriced overall in the long run. That's what makes covered calls and cash secured puts work. Active wheel traders use some serious discipline to stick to only selling options in the event that they are overpriced as measured by implied volatility. And of course, outside of volatility, the other sources for edge, like using support and resistance and such, a lot of the things we talked about last week and the week before, are all going to be carved in stone rules for these active type wheel investors. They're going to set out a set of criteria to get edge to maximize the likelihood of it being a long run profitable trade, a statistically advantaged trade. And some of these things, like if it's a skate trade using support and resistance, they'd be higher on the hierarchy of edge criteria. Active wheel traders want all sources of edge. They want to do everything possible to maximize the opportunity and start the trade out as strong as they can. And though thus far, they've really only sort of scratched the surface a bit, managing the trade also has very big influence on the outcome for any type of option trading, including covered calls and cash secured puts. So I guess what I mean is this. The most active wheel traders that are willing to put in the most time will only sell options when volatility is confirmed to be overpriced. Because that risk premium, it exists, but it doesn't always exist. Sometimes it's not there. Sometimes it's negative risk premium, but usually it's there. The active wheel traders only trade covered calls and cash secured puts when they're overpriced. How about passive wheel traders? While investors will statistically reap the benefits of adding overpriced volatility as one criterion to help their trades in the long run, the process of trading in cycles in and of itself adds an edge too. Trading in cycles means rolling the trade from expiration to expiration, keeping the trade going over time, over and over and over again for a long time. An investor couldn't possibly trade a long cycle and just keep rolling expiration after expiration if they're doing it actively and only trading covered calls, cash secured puts when implied volatility is overpriced. Sooner or later, it's not going to be, and they would have to stop. Quite a dilemma, isn't it? Should I forego requiring volatility edge for the sake of continuing the cycle? Or should I just sit this one out and wait for volatility to come back up higher before I sell more options? Passive wheel traders find continuity of the cycle more important than edge. They're willing to sacrifice that perceived overpriced implied volatility sometimes. And honestly, I would say that you could probably make a pretty strong case for this approach. Because options are statistically usually overpriced, the risk premium exists in the long run. Continuing a cycle through the long run just earns the average risk premium during that period. And this kind of calls attention to something important for market analysis of any discipline: humility. If my forecast is for the options I'm considering selling right now, if I forecast that right now they are undervalued, if I'm an active wheel trader, I just wouldn't trade it. But how do I really know for sure? What if I'm wrong? Well, that actually does happen. Look how many professional investors and traders were caught up in the 2008 financial crisis. Professionals. They got tricked just with everybody else. In any given instance, do I know for sure that implied volatility is underpriced or overpriced, even using the 1, 2, 3 volatility analysis? Not really, not conclusively. No one really does. You don't know until after the fact, after the option expires. Was historical volatility above or below the implied volatility of the option that I sold? But the one thing I do know is that the risk premium does exist in the long run. Trading passively can help an investor from hubris. I mean, not really even hubris. I mean, making a best effort to forecast something, but it can help protect an investor from being wrong. Just trade it passively. There is kind of a middle ground, though. And it kind of has elements of both active and passive wheel trading. Option traders who align with the premium seller school of thought have this saying: when in doubt, palms out. Palms out is the way that floor traders would position their hands to indicate that they're selling or offering options in the trading pits. When my palms are out, whether I'm holding up one finger or five or three or whatever, means I'm selling some sort of quantity at some sort of price. If my palms are in facing me, that's like, just picture it, that's like pulling something in, right? That's buying. So when in doubt, palms out. If I know there's typically an edge to selling, hey, if I'm not really sure what to do, I might as well sell. Act on the statistically most likely scenario. But time to time, there may be other market scenarios that have a history of playing out a certain way that can also be a cause for deviating from passive selling. For example, a lot of violent downward market moves usually end up forming a V-shaped bottom. And when that happens, a lot of time they just bounce higher and they can just really keep going, driving higher and higher with strong, strong, strong momentum. These are the kind of moves you don't want to be on the wrong side of. These big rebounds are the kinds of moves where you want to avoid selling your covered calls during. Oh, Now, the implied volatility might still be high in such a volatilely rising market, but the risk of giving up profit potential on the stock price blasting through that strike, it ends up outweighing the implied volatility benefit from selling calls in those cases. And the market experiences different volatility states or different volatility regimes during which implied volatility is underpriced for extended periods of time sometimes. A couple of days of low volatility, that's no big deal. That happens all the time. But weeks of it or months of it, that's a pattern. That's a pattern to beware of, because you might consider foregoing wheel trades under those circumstances. The key is to wait until a volatility pattern is established, so like weeks, not days, and then you can make this decision of staying in the market and following continuity, or sitting it out to either not sell too low volatility or to not get in the way of a freight train of a market busting higher or lower for that matter. Another consideration of when implied volatility matters and how much it matters is pure extent, I guess, pure dynamics. If implied volatility is a little high, okay, well, great. I probably would lean towards selling options, because if it's a little overpriced, that's great. I get a little advantage. If implied volatility is massively overpriced, but if implied volatility is massively overpriced, oh, well, then what? Well, that's kind of a different scenario altogether. If it's way high, there's probably something out there in the fundamentals, in the market news or something that somebody knows about and they bought a bunch of options to protect themselves or because they feel that there's a big move coming that I don't know about. So I like to sell options when they're expensive, but when they're too expensive, I start to beware. Another thing, whether the option is a short-term option or a long-term option. If an option has like a day or two until expiration, its Vegas, if you look at an option chain, its Vegas are very, very, very small. The implied volatility really starts to not matter much at all. None of the Greeks really matter when there's just one day until expiration either. But longer term options, well, they have bigger Vegas. Implied volatility changes can make a much bigger difference. Now, that being said, implied volatility doesn't change as much on longer term options. But when it does change because the Vegas are bigger, it makes a bigger impact. So it's kind of weird. You got two things that kind of counterbalance each other a little bit. Short-term options, they have small Vegas, but their volatilities change a lot. Long-term options, they have big Vegas, but their implied volatilities don't change much. And another thing where implied volatility can come into play has to do with earnings. I would say an investor can make a reasonable case by saying it's best to avoid carrying covered calls or cash secured puts into an earnings announcement. Stock volatility makes wheel trades less ideal, often causing cycles to be extended before a credit can be locked in. Each individual wheel cog either loses money or produces diminishing returns when the underlying stock is making outsized moves. That's the effect of negative gamma. Negative gamma means the delta of the overall covered call or cash secured put changes against you adversely. The delta either shrinks towards zero when the stock goes up towards a limited profit outcome, or the delta increases towards positive 100 as the stock price falls towards an increasingly severe loss. So basically, you win at a decreasing rate and lose at an increasing rate. But before an expected volatility event like an earnings announcement, which happens quarterly in the US, implied volatility can rise a lot in anticipation of the earnings announcement or whatever it is because of the higher probability of higher stock price action, a bigger move. History shows it's pretty common for the market to overprice implied volatility going into earnings, especially in the really short-term expirations. So this leaves us as wheel traders with important questions. If I'm going into an earnings announcement, would I plan to hold this stock through the earnings announcement, regardless of whether I have a covered call or cash secured put? Usually that answer is yes, but not always. How about this one? Based on past performance of previous earnings announcements, how big of a gap is reasonable to expect when the market opens following the earnings announcement? And also following the conference call, which is actually more important than the earnings announcement itself. All right, here's another question. Leading into the earnings announcement, if I were to sell the option, would its higher implied volatility, would that make its premium big enough to give it enough cushion to make up for the expected move, the negative gamma move? To understand the questions well enough to give good answers. We need very specific context. The two broad categories are selling puts going into an earnings announcement to potentially buy a stock, and also selling calls before an earnings announcement to maybe sell shares of stock. So both the trade objective. I personally hold long-term buy and hold stocks through earnings announcements, like I said. The fundamental metrics, sure, they change when earnings are announced. The PE ratios change because it's a new E earnings figure, right? But I don't know. I mean, I can't predict what the earnings report will be, or if I could, I still might not do well because I might not predict properly how the market would react to it. So I usually stick with the conventional wisdom. Just buy and hold the stock. So when I come across a company that fits my criteria for a value stock or a good dividend yield play or some other thesis, and when earnings is just about to be announced, I don't rule out buying the stock and holding it through the announcement. And this is where options come in. Implied volatility tends to be highest right before an earnings announcement. Sometimes that gives investors an opportunity to get into a stock by selling a put and do it at a favorable price that cash secured puts offers. We talked a little bit about synthetics and put call parity and such. And so I'm talking about selling a cash secured put here, but to be fair, if I really wanted to, instead of selling a cash secured put, I could buy shares of the stock and sell a call. Same thing. If an ex-dividend date falls between today and the earnings announcement, I'm much more likely to enter into a buy right so that I get to keep the dividend. But if not, I usually just sell the put. So imagine you just found a stock that you want to buy for whatever reason. It's trading at $150.63 a share, and earnings happens to be in 2 business days. You're considering whether to use options and whether they make sense in this scenario in order to buy the stock. So the first step is to get some idea, are options cheap or expensive for this stock? So you have to analyze the volatility. Options on this stock with the expiration date immediately following earnings are almost always going to have the highest implied volatility of all the expirations, and so would most likely be the best ones to sell. In this hypothetical example, because earnings is just 2 business days away, so that's the front expiration. Front expiration just means the expiration with the least amount of time. Let's also just make the assumption here that the company does not pay dividends. So for this example, we'll just focus on the front expiration and selling potentially a cash secured put. Let's assume your analysis says that this stock is a good buy, good value at its current market price, and you don't feel the need to sell some far away from the money strike put. It's better to capture the most time premium possible, which you'd get with an at the money put or a close to the money put that's slightly in the money. Compare that with an out of the money put. And not to mention, we're trying to get assigned. So compare that to an out of the money put, and you just have a better chance of getting assigned if you stay close to the money or a little in. Imagine the just in the money 151 strike put in the front expiration is $5.65 bid, which is 3.75% of the $150.63 stock price. And imagine those puts have a 56 implied volatility compared with the 28.1% historical volatility. And implied is near the top of the 6-month range on the volatility chart. So by those two standards, those are two of the standards in the 1, 2, 3 volatility analysis, right? By those two standards, implied volatility is indicating as high. And it should be because of the increased potential for the stock to move because earnings is coming. So the next thing I do is I look at the most recent 8 quarters of earnings gaps. And I define an earnings gap, by the way, as the difference between the stock price that it closed to end the session immediately before the earnings announcement compared with where the stock opens the session immediately after the earnings announcement. So basically, I'm talking about the overnight gap. Imagine the earnings gaps were anywhere between 1.1% and 3.4%, with maybe one anomaly that was 5.2%. And also notice here that I'm not making the designation whether the gap was higher or lower because I don't care. I'm not trying to pretend that I can predict the direction of a stock on earnings. I'm just looking at the volatility from a pure, in this case, gap size. So the one gap that I mentioned, it was a 5.2% gap. It was sort of the one anomaly. That could potentially be an issue because in this case, it will have shown that the stock could move beyond what, in this case, the sweet spot is. Let me kind of explain this. On this trade, so selling the 151 strike puts at $5.65, the break even is $145.35. That's 151 bucks minus $5.65 is 145.35. That is 3.5% lower because it's break even, so lower than the current stock price. The indifference point, if we want to look towards the upside, would be, let's see, anybody remember how to calculate the indifference point on cash geared puts? We talked about that before. We just simply take the stock price and we add to it the option premium. So 150.63 plus $5.65 is $156.28. That is 3.75% higher than where the stock is now. Okay, so let's recap. The break even is 3.5% lower than where the stock is. The indifference point is 3.75% higher than where the stock is. Between those 2 points is what I like to call the sweet spot, where the trade makes money and it outperforms the buy and hold. So in this example here, most of the time in the last 8 quarters, because the moves were between 1.1% and 3.4%, most of the quarters, it would have landed in the sweet spot. Like if this were to play out again today, we'd be okay most of the time, except for that one anomaly one, the 5.2% move. The stock moves 5.2% up or down this time, then either I'm going to lose some money if it goes down too much, or I'm going to leave some money on the table if it goes up too much. So do you see what I'm doing here? I'm using implied volatility to extract some information out of this trade to help me decide whether I should do it or not. It's pretty cool, right? And in a situation like this, where there was only one gap out of the last 8 quarters that would result in busting out of the sweet spot this time around, I might be willing to take my chances with that. I might be willing to do that. I might be willing to say, hey, as long as the stock doesn't move more than 3.5% down or 3.75% up based on its history. It usually doesn't. I like this trade. I like it a lot. And you can use this math with the skating objective or the trade objective. Now let's talk about selling calls going into earnings as a way to be able to sell the stock at a better price upon earnings. First of all, why would I do that? Well, because when I buy a value stock, I think it's a good value. It's a low price for the value of it. Well, I'll buy that. But then, hey, if I'm right, hopefully one day I'm right, the stock will have gone higher and maybe even much higher. And so at that point, the price might now be above value. And if the price is above value, then I might not want to own it as much. I mean, unless it's a dividend play or something like that. But in some cases, I might want to sell the stock. As a divesting strategy, I might consider selling a covered call before an earnings announcement when the implied volatility is really high. And I would do it to try and sell the stock at a better price than I could at the current market price. So imagine I own a stock trading at $137.81. It has earnings scheduled for tomorrow, which is, we'll just say like a Wednesday, after market close, AMC. The nearest to the money call is the 138 strike call. The 138 strike call that expires this Friday, so 2 days after earnings, is trading at $4.05 or 2.94% of the stock price. So note, implied volatility is, of course, high because earnings is coming, right? That's the whole point of this. This is effectively the same idea as selling the put as a strategy to buy the stock going into earnings. Again, we compare the past gaps to the percentage of the stock price movement that is cushioned by the credit that we receive, premium. Imagine the stock never had a bigger gap than the option premium percentage that leads to the break even and a difference point. That creates the sweet spot. If any of the gaps happened today, it would not be big enough to bust out of the sweet spot. Here, the break even, and let's just run through the numbers. Here, the break even is the stock price minus the option premium. So 137.81, I said, right? Minus $4.05. The downside break even is $133.76. Which is 2.94% lower than the stock price. The indifference points are now above the stock price. That's the strike plus the option premium. So 138 plus 405 equals $142.05. So that's 3.08% above the stock price. So if the stock in the last 2 years on earnings never gapped more than, and I just take the smaller one, 2.94% here. If it's never gapped more than 2.94% on earnings in the last couple of years, then it's probably going to end up in the sweet spot here, right? This is a technique that I developed from an earnings trading strategy that I came up with, but I use it for my covered calls and cash secured puts too. It's very, very useful. One nuance with writing calls to try to sell a perceived overpriced stock is that greater focus needs to be put on the risk of not getting assigned. I mean, just compared with selling a put to buy the stock. I mean, if I don't buy the stock, I miss opportunity. But if I don't sell the stock, then I lose money. Worst case scenario. The risk really is that the stock goes down too much. So one way to somewhat manage that is sell an at the money call. Maybe even an in the money call. The benefit of selling an in the money call is that you have a much greater likelihood of assignment. And because in the monies have a bigger total premium, you have a lower break even, right? But the overall advantage that's actually gained is limited to the time premium over parity, not the intrinsic component of the call premium. And this is sort of, I don't know, a very different way to look at this. And those of you who are pretty experienced with options, I'd be curious what your thoughts are in what I'm about to say. Feel free to leave a comment afterwards and let me know what you think. But when we're talking about in the money options, and specifically because we're talking about covered calls, we're talking about owning stock and selling an in the money call, because it has intrinsic value and time value. The intrinsic value you can think of as a direct hedge. It helps when the stock falls, but likewise offsets gains when the stock rises. But time value, that just helps either way. You get to keep the time value. So beware of going too far in the money if you're selling in the money calls, because like a really deep in the money call is almost can be almost all. It can be all intrinsic value with no time premium. So all hedge, no benefit. Even though an out of the money call is all time premium, it's typically less attractive in the case of wanting to sell a stock because there's not as much downside protection and it's less likely to be assigned. So when I do this technique of selling a call to hope to get assigned and taking advantage of the inflated option premium going into an earnings event, I really don't do out of the money calls. I do at the monies, just in the monies. With either of those two techniques, you could be tempted to sell a call with more time until expiration because you get a bigger premium, and that's fair. But consider the theta analysis that we've talked about, the risk of having more time until expiration, and therefore more risk of the stock moving before assignment can occur. That can usually end up it being better to sell short-term options for these purposes. And that about wraps it up for this show. But before you go, please make sure you're subscribed on your favorite podcast platform, whether it's Spotify, Apple Podcasts, or whatever it may be. And if you'd be so kind as to leave a comment, I would really appreciate it. Until next time, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.